Hello everyone, and welcome to the episode number 21 of JustDario Cigar Time. Today's episode is going to be very special because there is a lot to talk about. And I will try to do my best to cover everything, to explain you what's really going on, and in particular, to make clear to everyone that stocks aren't crashing. They just started to detox. Am I crazy? Did I miss what happened in the past 2 days? With S&P 500, Nikkei, Euro stocks all free falling to a degree that wasn't experienced since the 2020 COVID crash. No, I haven't missed anything of all that happened. As a matter of fact, 2 months ago, I wrote an article predicting exactly what happened. In that article, I explained why making America great again was such a bad news for many greedy US investors, that all they care about was their interest, their stocks going up, and their profit keep piling up across all of their accounts, while the economy all around was in a worse and worse shape. But who cared, right? This week, President Trump made clear to the whole world that it is very focused and motivated to fulfill his electoral mandate, an electoral mandate that has been granted to him by the vast majority of the population of the United States, that has seen his standard of living crashing to lows that are so shameful for a developed economy, but in particular so shameful for the biggest economy in the world. And this was happening. In the meantime, the Biden administration continued to pretend the economy was doing great, the inflation was much lower than what it was reported, and that stock markets flying to the moon was a sign that Biden and his people were getting everything right. The truth, of course, was the complete opposite. Reason why Trump won by a landslide in the last US elections. Of course, the amount of criticism that Donald Trump received in the past 48 hours has been, needless to say, like huge and coming from every front. People like criticizing his formula, his approach, making fun of him because perhaps his people used ChatGPT in order to draft the table with the summary of all the tariffs applied to all nations, so on and so forth, how he doesn't know what is he doing, and blah, blah, blah. Not a single person in the financial media dared to criticize Joe Biden. Not a single one. And this is so intellectually dishonest. Now, let's look properly at what Donald Trump is trying to achieve. What are going to be the consequences of his actions, direct and indirect, in the short, medium, and long term, both for US stocks and global financial market. And hopefully, by the end, everyone will have a better idea on how to navigate this incredible volatile time that are set to continue for quite some time, because this time Trump is not gonna cave, is not gonna swallow back his threats, and is not gonna walk back his actions, because, as I warned many times, he learned from the mistakes of the previous mandate, and now that he's in his second and last mandate, he is working mostly to leave behind a good legacy and memory about him, effectively saying fuck off to all those many people that during the first term pulled his jacket left and right and threatened him to withdraw the support for his re-election campaign, something that eventually did in order to put Biden into the White House and unleash 4 years of pillaging of the real economy. All right, now let's have a look at what's happening in the very short term. Is Donald Trump intentionally crashing the stock market? No, what Donald Trump is doing is effectively pulling the plug that has been feeding opium to stocks for so many years, even under his previous presidency, because clearly, and contrary to what the Nobel Prize Ben Bernanke has been preaching since decades, increase in the value of the asset prices doesn't have any trickle-down effects whatsoever into the real economy. Rich people that benefits for the increase in asset price keep them for themselves, period. And Donald Trump just pulled the plug to that and is imposing a drastic shift to the mindset of traders that now are going to be forced to give a closer look to the real fundamentals of a company and the real degree of performance of its business within the real economy. A real economy that currently is characterized by more and more consumers that are being choked by inflation, that they max out their consumer credit and they cannot simply make ends meet anymore. This means that a lot of companies will not be able to raise prices any further. If these companies won't be able to raise prices any further, where are tariffs gonna impact their income statements? Of course, they're gonna impact margin. And this time around, they are going to impact margins to a degree that investor won't be able to ignore them anymore. Furthermore, they won't be able to assume Donald Trump is going to pull back like he did the previous time. Lower margin will translate in lower earnings, present and for the future. Lower earnings that are here to stay and that will inevitably impact the valuation that investors are going to assign to companies, because present value of future earnings that now they're going to estimate is going to be much lower than what they were expecting just a few days ago. And an expectations that till the very last minute, they didn't give up, because let's not forget that just a few minutes before the official announcement of the tariffs, investors were still busy shorting volatility and mounting long position into stocks in a strong belief that ultimately Donald Trump will not have had the guts of pulling the rug from underneath the stocks, and his announcement for reciprocal tariffs to the rest of the world would have been much milder than what they effectively kept warning all the financial market about, and still nobody wanted to believe what came out from the White House till the last minute. Reason why we saw an incredible reaction on Thursday and Friday from stocks all around the world. A reaction that has been mainly driven by hedge funds. Why hedge funds? Because hedge funds trade on leverage. And the amount of leverage that these people piled up in the recent year is humongous. Reason why, if they get a trade wrong, they have to unwind this trade very, very quickly. And this is exactly what happened and what I kept warning about. And it just came out that hedge funds saw the highest amount of margin calls in the past 48 hours since the COVID crash. Be aware that these past 48 hours were not enough for all people that had leveraged long position outright or using derivatives across the world to unwind their position. As a result, I do expect markets to remain weak in the following week because of this stream of liquidation that will keep hitting the tape. Stream of forced liquidation, because the core of this market, despite what just happened, remains very bullish, in particular with retail investors on Thursday that bought the largest amount of stocks and ETF in a single day ever, pouring into the US stock market alone $4.5 billion, and effectively making themselves exit liquidity for all those financial institutions that were scrambling to reduce their losses and protect their capital as much as possible, not to go out of business. Don't worry though, I don't think we are gonna see a Black Monday. And I'm saying this because once all these hedge funds liquidations will be done, there is gonna be a period of consolidation, perhaps a dead cat bounce, because all institutional investors out there are gonna need time in order to reassess their portfolio allocation strategies and consideration in financial market. On Thursday and Friday, we saw most of these institutional investors trimming considerably their exposure into stocks, in particular to Mag 7, where, as I always warn about, they were overly exposed. And where did they put this cash? They put this cash into US government bonds that saw the yield collapse. But be careful for all the people that are saying that Trump is intentionally putting the economy into a recession and that will crush inflation. They are completely wrong because they are ignoring the immediate impact of the tariffs, that of course is going to be an increase in price, but also the medium and the long-term impact of tariffs, because as it has been observed in the past, companies will start strategizing and trying to project and manage their inventories and their productions and manage their supply chain as a result for the moment that tariffs will be lifted. These will result in shortages of goods across economies because of lower supply. And as we have seen during COVID, what happens when there is a shortage of supply? Prices keeps going up. And if this wasn't enough, this year, the US Treasuries need to refinance 1/3 of its debt still. Debt that was raised at 0% cost effectively during the COVID years and now needs to be rolled at a much higher cost. And this will put pressure on the deficit, ultimately increasing the total amount of debt burden of the United States that currently isn't raising simply because the debt ceiling hasn't been increased higher yet, and the Treasury General account is being drained as a result to pay for the current operations of the government. You can easily understand how all this tailwind behind inflation will not allow yields to go lower in what is effectively going to be a repeat of the 70s. And this isn't even going to happen if Trump is successful in forcing the Federal Reserve hand in cutting rates, as it has come out explicitly saying in the past hours. They won't be successful in containing the decrease in yields because investors won't be willing to see the real value of their capital being eroded by inflation and investing into government bonds at real negative interest rates. That has been the case for years now, and they're aware of that, even if the official public data have been saying that inflation come down and according to them, real interest rates have been positive. Something that has been clearly debunked by the behavior of interests in the market that remain elevated and, as a matter of fact, kept rising even after the Federal Reserve tried to cut rates. So clearly, government bonds are just seeing a very temporary bid. And already by the end of Friday, we started to see rates going on the way up with the 10-year US Treasury yields almost at 4% again. And I tell you, in the medium term, rates are continuing to go higher because there is nothing that can pull them down yet. So government bonds are not going to be a good solution to rotate away from stocks. What about corporate bonds? Of course not. And the reason is credit spreads are still incredibly low despite all this happening. And this is another item that I keep stressing about. What's happening right now is not creating any stress into the global financial system because central banks are keeping financial conditions incredibly loose. And even if some central banks are already very active in perpetrating in emergency liquidity measures into the system, like the Bank of England and the Bank of Japan, the Federal Reserve, as of Friday, didn't lend any emergency liquidity through its repo facility, as a clear sign that banks are not in danger yet. So as a result, in order to fend off the pressure from inflation, in the medium term, we are going to see investors rotating in all sorts of assets that have limited supply. And the asset that stands amongst all because of its characteristic right now is gold, without any shadow of a doubt. An asset class that is going to see massive amount of tailwind from an economic perspective, but also from a central bank perspective, with more and more central banks rotating their reserves from fiat currencies into hard asset and especially gold. And it is news that came out Friday after close that the German central bank is considering to withdraw another tranche of its physical gold reserves currently held at the Federal Reserve of New York. How do you expect this is going to impact the price of gold in the medium term? The first time they tried to do this, they took 7 years to get their gold back. This time around, when it's clear that the physical gold is not there in the vaults as expected, but IOUs are there instead, for all the reasons that I explained in previous podcast, there is clearly going to be pressure in the market to buy this gold, getting in the lever back into the vaults, and then transfer that to the rightful owner, increasing the pressure into the system overall that right now sees a ratio between paper gold and physical gold of 100-1. So even if gold saw its price, fiat currency, going down in the past hours, relatively speaking, and for an amount much lower than the overall market, the price will continue to grind higher and higher, breaking new all-time high because of all these reasons. But of course, investors will not be able to overexpose themselves to gold because there is so much that they can purchase without blowing up the price. So I expect other type of assets, in particular hard commodities, and frankly speaking, I expect also Bitcoin to continue raising in price. And Bitcoin that saw a substantial bid and closed green on Friday in what is already a clear stance by the institutional investors crowd that already recognize Bitcoin as a fully fledged financial asset and are gradually increasing the allocation through the various ETF available in the market that, no matter the fluctuation in prices of the recent month, continue to accumulate Bitcoin and hence contributing in reducing the supply available in the market to a degree that at some point should not surprise anyone to see Bitcoin start raising sharply again and resume trading above $100,000 per Bitcoin. As you can understand, overall, what's happening right now is a result of a still ample amount of liquidity sloshing around in the system. It will simply move away from stocks that now have not much narrative they can rely upon and are doomed to crash back on earth to sustainable valuations. And this liquidity will move elsewhere, potentially even creating bubbles in other parts of the financial system. Why not? But this brings us to the effect on the long term, when inevitably the crash in stocks and the detoxing from all the unsustainable debt that is both at a government level and a consumer level will be ultimately bringing everyone to the point that defaults are going to start to raise sharply, already raising sharply in some parts of the economy, but still banks can be allowed to hide the losses in the hold-to-maturity books. Something that the more we go on in time, the less leeway they're going to be. And some central banks, like the Swiss National Bank, are already pushing hard their banks, in particular UBS, to raise significant capital. And I want to spend a few minutes on this. Why UBS? UBS now is double the size of the Swiss economy. So differently from the case of Credit Suisse, where there was some room to bail out that bank, something that has been done very wrongly, as explained many times. In this case, Switzerland is effectively going to find itself in the same situation Iceland was in the beginning of the great financial crisis of 2008. So even that safe haven that is the Swiss franc right now is going to fall apart. So in the long term, like it or not, there is going to be another great financial crisis. And everyone that thinks that central banks will be able to bail out everyone once again from their misery is wrong. And why is wrong? Because central banks are piling up on losses and they expand their balance sheet so much that it's completely unsustainable for their underlying economies. And they will have to choose whether to support the private sector or governments that will have a very hard time to cut their deficits and rebalance their finances by the time bank will be in trouble. So next time, central banks will be busy to bail out governments and will have to take hard decision of which banks let go, which banks can be merged to another bank, and which banks will be allowed to operate with incredibly big balance sheet that ultimately will be needed to shrunk to sizes that will not be too big to fail anymore, but right now too big to bail out. So either banks will raise significant amount of capital in the foreseeable future, or the governments will be forced to split it up. So the end game in all of this is a massive debt restructuring in the overall system. And all I'm describing is a process that is going to last years and just started. This is why stocks are only detoxing right now, but also why banks have been the most impacted into this process in the past 48 hours, because institutional investors in particular are not oblivious to the risks of the financial system at all. They simply ignore them so far because, as explained many times, all these investors were forced to stay in the market in order to remain competitive and clip their fees, because anyone that was not overinvested in the market and raised safer amount of cash ultimately ended up being penalized and losing AUM to people that on the other side were maintaining a full exposure to the overall system and remain committed to the momentum trade. To conclude, the best strategy in all of this is not try to trade this market. It's going to be very difficult. Volatility is going to be substantially higher compared to the previous years where we saw ascending low of volatility in the system because everyone was harvesting yield of shorting volatility in order to improve their performance. So trading this market is going to be something impossible even for professional trader. And for retail trader, the best would be to try to take the gains that are still in place to move into safer alternatives like T-bills, not cash, because I explained many times that will be exposing yourself to banks' credit risk, hard assets like gold that can protect against inflation, and already screen the market for potential technical opportunity that can be purchased when at the very bottom people will be liquidating everything in these pairs, and in that time also throwing away diamond along with all the rubbles. And there is no better example right now that of the best positioning that can be taken in the market than Warren Buffett, a person that people were joking about for raising hundreds of billions of dollars that he parked into T-bills. But once again, Warren Buffett has been proved right. Berkshire Hathaway is one of the best performing stocks in the market this year because people see that as a potential safe haven, and even despite his age, he might be able to pull off the similar amount of incredible trades he pulled off during the GFC, as representing the perfect stance and asset allocation that you can have right now. Because let's not forget that there are two rules to continue compounding wealth investing your savings. One is avoiding painful drawdown, and the second is to be able and disciplined to buy assets at the very bottom where they are at cheaper valuation, but nobody will be willing to touch them. And many times this has been proved the winning strategy after the 1929 crash, after the 1987 crash, after 2000 and 2008, and even 2020 to a certain extent. With the only difference that next time central banks would not be able to pump everything up so quickly. So ultimately, if they don't want to destroy all the modern fiat monetary system, they will have to as well behave in a way that is not going to privatize the gains, but make the losses public to everyone, because currently no one can afford to pay them anymore through inflation. Thanks a lot for having listened to me once again. I wish everyone seriously good luck in this market. Thank you for supporting my channel, for subscribing, for supporting me on X, and following my tweets that I put out every day, trying to help people navigate what's happening in real time, to follow me on Instagram, and to reading the articles on my blog that more and more are being proved to be correct forecast of future events. But apologies for everyone if I was too early and everyone was too distracted by the bull market at that time to understand. But maybe at this time it might be useful to go back and read them, because what's going to happen in the future has been already written in the past. Have a nice weekend, everyone. Take a good rest and talk soon.